Think of a Roth IRA as a financial vault. Once your wealth is secured inside, the IRS loses its legal authority to tax those funds, even as the balance grows over several decades. Every dollar inside this account compounds without friction. When you eventually withdraw the money, the government cannot take a cut of your capital gains, dividends, or the original principal. This specific tax structure exists because of the Taxpayer Relief Act of 1997. It bears the name of Senator William Roth, who advocated for a system where Americans could pay taxes up front to secure a life of untaxed retirement income. The strategy operates like a toll road. You pay the fee at the beginning of the trip to ensure the rest of the drive is free. To qualify for that future benefit, you must fund the account using after-tax dollars, money you have already paid income tax on this year. While many mistake it for a specific stock or bond, the Roth IRA acts as a protective wrapper. You choose the underlying investments to place inside, but the wrapper permanently changes the tax status of your future wealth. This creates a mathematical fork in the road. A traditional IRA provides an immediate tax deduction today, but you pay the IRS when you retire. A Roth requires you to pay those taxes now in exchange for a completely tax-free payout later. This chart tracks a $7,000 annual investment over 40 years. The lower line shows a standard taxable account, while the upper line represents a Roth IRA. As the lines separate, the highlighted wedge shows the massive tax savings you keep instead of paying the government. However, notice this initial dip in year one. Because you use after-tax money, you cannot use those funds to lower your adjusted gross income today. Your adjusted gross income is your total income minus deductions, and lowering it is the primary way people reduce tax bills. The long-term math is compelling, but the IRS complicates the process. They strictly limit who can contribute to these accounts based on annual income, turning a simple savings plan into a strategic maze. Success with a Roth IRA depends on a single calculation, comparing your tax bracket today against where you expect to be in the future. It transforms retirement planning into a game of tax arbitrage. Consider the first profile, the early career earner. This individual typically sits in a low or mid-tier income tax bracket. In this scenario, the inputs are high. You can contribute up to $7,000 of post-tax dollars annually, assuming you meet the IRS requirements for earned income. The outcome is a massive multiplier. By starting early, you lock in decades of compounding growth that the IRS can never touch. These accounts also offer unique flexibility. You are permitted to withdraw your principal contributions, the actual money you deposited, at any time for any reason without taxes or penalties. The rules for your profits, however, are much stricter. Your investment earnings are generally locked away until you reach age 59 and a half, and the account must be at least 5 years old. For young earners, the math is clear. It's better to pay a small tax bill now while your income is at its lowest point, ensuring that every dollar you earn from here on out is yours to keep. We move to the high earner profile, which faces a hurdle known as MAGI limits. MAGI stands for Modified Adjusted Gross Income, which is your total income with certain deductions added back in to determine your eligibility for tax perks. If your MAGI exceeds certain levels, roughly $144,000 for single filers in recent years, the IRS legally bars you from making a direct Roth contribution. To bypass this, many utilize a legal workaround called the backdoor Roth. The mechanics are simple. Non-deductible contributions in a traditional IRA slide immediately into a Roth IRA, but high earners often trip over the pro rata rule, which penalizes you if you have pre-tax money sitting in other IRAs. If you have other IRA balances, the IRS treats your conversion as a proportional mix of taxed and untaxed money. This results in an immediate, unexpected tax bill on the backdoor transfer. The backdoor Roth remains a top-tier strategy for high earners, but it only functions safely if your traditional IRA accounts are completely empty before you begin. Our final profile is the pre-retiree. These investors are often looking to eliminate required minimum distributions, or RMDs. RMDs are mandatory annual withdrawals the government forces you to take from traditional retirement plans once you reach age 73. To avoid these forced sales, many perform a Roth conversion, moving large balances from a pre-tax 401k or traditional IRA into a Roth IRA. This provides a dual benefit. It eliminates future RMDs and creates tax-free inheritance for your heirs. The immediate cost, however, is extreme. You must pay ordinary income tax on the entire amount you convert during that calendar year. Converting a large balance creates an artificial spike in your annual income. This frequently pushes retirees into a much higher marginal tax bracket than they would otherwise occupy. Attempting to build a tax-free legacy can trigger severe financial damage if the conversion isn't modeled with professional precision. The financial impact of a conversion extends into your government benefits. For those already in retirement, a large conversion often triggers IMA, or the Income-Related Monthly Adjustment Amount. IMA is a surcharge added to your Medicare Part B and Part D premiums if your income crosses specific thresholds. Because the Social Security Administration uses tax returns from 2 years ago to set today's rates, a Roth conversion performed now will result in much higher Medicare premiums 2 years down the road. Furthermore, that sudden income spike can accidentally trigger the Alternative Minimum Tax, or AMT. The AMT is a separate calculation designed to ensure people with high incomes and many deductions still pay a baseline amount to the IRS. In the past, you could undo a conversion if you realized the tax bill was too high. However, the U.S. Capitol oversaw a major change in 2018 that permanently banned Roth recharacterizations. There is no longer a reversal process. Once you execute a conversion and create that tax liability, the bill is final. For pre-retirees, these conversions are high stakes. You must ensure that the eventual tax savings aren't completely neutralized by immediate tax hikes and increased Medicare costs. To wrap everything up, let's map these 3 scenarios into a final framework for your retirement. This matrix provides a definitive guide to the Roth IRA and specific risks for each group. For the young earner in a low tax bracket, the answer is a clear yes. You should begin compounding your wealth tax-free as soon as possible. For the high earner, the backdoor Roth is an excellent choice, provided you have no existing IRA balances that could trigger a pro rata tax bill. For the pre-retiree, you must be extremely cautious. Only convert if you have modeled the impact on your tax bracket and your Medicare premiums. The Roth IRA is a precision instrument. When used with a strategy tailored to your specific income and timeline, it is one of the most effective ways to secure your financial future.